In 2026, many federal employees and retirees will see a second consecutive year of double-digit increases to their FEHB premium costs. Premiums are only one of several out-of-pocket costs that you may experience with your FEHB plan, but it is the cost that will immediately affect your biweekly paycheck or your monthly pension income. Before we dive into the details about the pending premium changes, welcome to the Money Briefing. My name is Jarrell Harvey, and I'm with Fedway Financial. On this channel, we cover topics related to personal finance, federal benefits, and retirement planning. So if you find this video helpful, please consider sharing and subscribing. Rising healthcare costs can put a strain on retirement income. Many reports show medical expenses are growing faster than most other costs in the United States. The price of care and the services that come with it are a very contentious topic, and they have been a sticking point in the recent federal furlough negotiations. Prices for hospital stays, physician visits, and prescription drugs tend to rise each year, and insurance companies often increase premiums to help offset or cover those expenses. In 2026, federal employees and retirees will pay an average of 12.3% more toward their health insurance premiums. This marks the second consecutive year of double-digit rate increases. This chart shows how FEHB premiums have increased for participants over the 10-year period dating from 2026 to 2017. On average, the employee and retiree premium cost has risen by a cumulative total of 70%, or 7% on an annualized basis. That percentage has far outpaced the average pay raises for current employees, as well as the cost of living adjustments for federal retirees. Premium hikes can negatively affect both employees and retirees, but they are likely to have a bigger impact on federal retirees, especially those who come under FERS. One of the reasons is because most FERS retirees do not get a cost of living adjustment to their pension until they reach age 62. So a federal employee who retires at age 57 may go 5 years without any adjustment to their pension plate. Plus, even after FERS retirees become eligible for a cost of living adjustment, they do not receive a full COLA when inflation increases by more than 2%. As a result, consistent large increases in FEHB insurance premiums can gradually eat away from a retiree's take-home pay. For example, Blue Cross Blue Shield Basic is one of the most popular health insurance plans under FEHB. In 2026, the self-only basic plan will increase by 18.2%, which is about $45 more per month. For married couples who have self plus one coverage, their premiums will go up by 16.5%, representing an increase of almost $98 per month. So let's say you're a federal retiree who receives a pension check of $2,000 per month. A 2% COLA will increase your gross monthly pension by $40. Therefore, a retiree in this situation, not considering taxes or other deductions, will take home about $5 less under self-only coverage and $58 less under the self plus one plan. For federal retirees with larger pensions, their cost of living adjustments are more likely to offset a rise in premium costs. However, for those with smaller pensions, their annual COLAs may not be sufficient to cover the increases in FEHB premiums. Given the recent trends and future expectations, it's important that federal retirees plan for healthcare costs that will continue to outpace most annual costs of living adjustments. It's also very important to choose the right plan that properly balances both costs and coverage. Although we have mainly focused on premium costs, there are other costs to consider when evaluating the plan that's best for you. If you or a family member has an existing medical condition, it may be better to pay a bit more in your premiums in order to save money on various out-of-pocket costs such as co-pays, deductibles, co-insurance, and out-of-pocket maximums. Another crucial thing to consider is your enrollment type. If you and your spouse are both federal employees or federal retirees, it might be cheaper to have two individual plans rather than being under a self plus one plan. It's also generally better to be under an active employee's plan rather than a retiree's plan due to the premium conversion. This tax benefit allows current federal employees to use pre-tax dollars to pay for their share of FEHB premiums rather than after-tax dollars. Because the open season occurs every year, FEHB participants are never tied to only one plan. As you transition to various stages of your life, your healthcare requirements may also change. So if you feel like you're overpaying for your healthcare plan, or if you think your plan is not meeting your coverage needs, check out other options to see whether a different plan could provide better value for you and your family. If you've received any value from this video, please click the like button. You can also subscribe to our channel to get more content like this. If you're interested in seeing how we help our clients at Fedway Financial get the most out of their money and federal benefits, please visit our website at www.fedwayfinancial.com, or you can click on the meeting link in this video's description. Thank you for watching, and we'll see you on the next Money Briefing.